Hello and welcome back to the channel. Since my first video about GameStop was uploaded around last month, around August, early August, the stock has gone up approximately 128%. But is it still undervalued? Now, before we get into the analysis, let me acknowledge that yes, I'm well aware of the perception that GameStop currently holds in the minds of consumers. People immediately tend to equate it to companies such as Blockbuster. It's possible that you may have only recently gotten interested in GameStop because of Ryan Cohen's involvement. Well, what if I was to tell you that GameStop is currently sitting on $12 per share in cash on its balance sheet, while it's traded on the market at approximately in the $5 to $9 price range? Does that make it a bit more interesting? GameStop is a Fortune 500 cash-rich business that's gotten a negative perception around it. It's literally priced for failure. There are multiple catalysts that would enable GameStop to turn its business around within the next few months. And I'll try to mention all of them so you have a good overview about the company. Let's start by going through the highlights of their most recent earnings announcement for Q2. After that, I'll be going over what we could expect in the next 2 to 3 years for GameStop. Do hit like and subscribe if you haven't already to keep up with the future videos. As per the recent earnings update, we saw that net sales were down almost 27% year over year. Same-store sales were declined by almost 13%, and global e-commerce sales were up around 800%, accounting for 20% of the total revenue. Historically, the second half has always been stronger for GameStop, especially the Q4. This year, Q4 is expected to have a significant boost due to the release of the new Sony PlayStation and Microsoft's Xbox. Not only will sales be higher, but it's expected that a lot of older consoles may be traded in. This is a core component of GameStop's strategy, where they have the option of being able to trade in old consoles. Also, the 800% increase in e-commerce sales for Q2 was not a one-off event. In Q1, they had managed to increase their e-commerce sales by almost 500%. It's part of their new strategy to turn the company around with an asset-light business model. Another key factor to have noticed in the earnings was that they were able to reduce the inventory by around 50% year over year, and were able to increase the cash that they had on their balance sheet to approximately 735 million. Now, the company has approximately 65 million odd shares outstanding. If you were to look at the company from a net cash per share perspective, the company has around $4.6 per share, accounting for all the liabilities owed. Just to add some perspective to that, 6 months ago, GameStop was trading at around $3 per share. As GameStop continues to close more stores globally, the reduced rent and property management obligations will translate to lower expenses, thereby adding to the already strong cash position that the company holds. Last year, they had closed 321 stores. In March, 300 more stores were set to close. The company has planned to close approximately 400 to 450 stores globally. They currently have just over 5,100 retail locations worldwide. Q4 has always been the strongest quarter for GameStop due to the sales increasing in the holiday season. This year, the trend is expected to be a lot stronger due to the release of the new generation gaming consoles. In October, November, December, and Jan is when we'll be seeing the new consoles being sold, and we'll see a lot of people trading in their old previous gaming consoles. And this, like I mentioned earlier, is a major revenue driver for GameStop. Amazon isn't taking back people's old gaming consoles, so we'll see a lot more people return to the GameStop stores and using the GameStop app. GameStop has dramatically reduced its inventory while transitioning into an effective multi-channel retailer. As we see the stock price rise higher in Q4 and beyond, the perception of analysts and the market as a whole would change around GameStop, in my opinion. It's possible that we could see positive momentum build up in the stock. We've seen the impact of what positive momentum can do to a stock when you look at how much Tesla, for example, has gone up in the last few months. Many of you know that the reason for Tesla spiking higher was due to the short squeeze, where the short sellers were essentially left with nothing except their shorts, as Elon had tweeted. GameStop is going to experience a short squeeze that will make Tesla's short squeeze seem like nothing. The reason for that being that out of the roughly 65 million odd shares that GameStop currently has outstanding, just over 58 million shares are being used to short the stock. In the event that the shares are recalled by the shareholders and shorts are unable to cover their position, the stock price will continue to rise higher and higher, thereby further squeezing the short sellers. This catalyst, it's a matter of when, not if. When I had initially gotten interested in GameStop, the release of the gaming consoles and the potential short squeeze were the two main catalysts that made me actually want to look into the stock as a potential quick gain of roughly 300 to around 500% in 6 to 10 months. Then came along a 13D filing by Chewy founder and contrarian investor Ryan Cohen. Last month, around mid-August, Ryan Cohen filed a 13D stating that he owned 9.6% of GameStop. And right as the filing closed, the stock jumped approximately 24% in a single day. Now, there are two scenarios that could play out with Cohen's involvement in GameStop. He could either take the company private, or he could improve the company as an activist. I'll be discussing both scenarios and what are the likely outcomes from my point of view. But first, for those who aren't familiar with Ryan Cohen, let me give you a summary and explain why him investing in GameStop made such an impact on the stock. Cohen is a founder of a publicly listed company called Chewy. It's a pet food and pet supplies retailer that was able to compete with Amazon and not only survive, but thrive. In fact, they beat Amazon in that niche. Cohen sold Chewy to PetSmart a few years prior to the IPO for around $3.5 billion. He then invested a major chunk of the proceeds into just two companies, Apple and Wells Fargo, with Apple being the larger concentration. Cohen describes himself as a contrarian investor who looks at a lot of investment opportunities, but says no to almost all of them. His criteria includes focusing on asset-light businesses that need very little cash to fuel their growth, while having a durable competitive ability to grow earnings over the long term and maintain strong cash flows. So let's go through the first scenario. Ryan Cohen takes GameStop private. Now, if we take an in-depth look into the 13D, we will find that it was filed by Christopher Davis on Cohen's behalf. Davis shares Kleinberg Kaplan's mergers and acquisition and investor activism group. A leader in the activism space, Davis advises domestic and international clients on shareholder activism, proxy contests, and tender offers. Also, a 13D is filed with the intention of activism, along with influencing the management and the board of the company. If an investor is looking to purchase a significant stake in the company without the intent of being an activist, a 13G is filed with the SEC. GameStop is a Delaware incorporated company, so Cohen only needs over 50% of the shares to force a short-form merger. It is unlikely he could get to over 50% of the shares due to the involvement of other activists, large shareholders, and passively managed funds. Cohen could negotiate with the board of directors to come to an agreement in price. Shareholders will likely demand over $20 per share to get it done, because that's the price at which some of the larger shareholders were buying the stock previously. It's crucial to keep track of Ryan Cohen's buying activity to see if he crosses the 10% threshold. Now let's go through the second scenario, where Cohen decides to leverage his experience and knowledge gained from building Chewy, and he works with the management of GameStop in order to restructure the business and turn it around. In an interview, Cohen said that Chewy played by Amazon's rules for supply chain, logistics, and the convenience of shopping online, but added its own differentiator, the old-fashioned customer service of a neighborhood pet store, for its winning strategy. In my opinion, the key point that Cohen will leverage are GameStop's 5,000 plus retail locations worldwide. Many retail stores being closed will be replaced by fulfillment centers to cater to the increasing e-commerce business, which I had mentioned earlier rose by approximately 500% in Q1 2020 and around 800% in Q2 2020, and accounting for almost 20% of total sales. Streamlining the logistics will dramatically decrease costs because rent per square foot for fulfillment centers is a fraction compared to the retail stores in a densely populated area. For the stores that do receive the most in-store traffic, he's going to influence the management and revamp the entire in-store experience for gamers at GameStop. Cohen realizes that it is a lot more convenient to purchase products online, and a physical retail location should offer the benefit beyond just a point of purchase. The in-store physical presence needs to be appealing enough for consumers to keep coming back. Esports is a rapidly growing market, and GameStop will hopefully pivot in a direction in order to take advantage of that growth trend. Now, what is the likelihood of either scenario playing out? Your guess is as good as mine. It's a 50% possibility either way. Hopefully, we get a better idea about Cohen's intention within the next few months. Until then, we've got the short squeeze and the new gaming consoles to look forward to as catalysts. Also, let's not forget the growing cash pile that's sitting on the balance sheet. In my opinion, GameStop isn't just a short-term trade anymore. The company has the potential to grow over the next few years. It's very plausible for the company to be earning more annually than its entire market capitalization. With the cash generated, the management and activist investors could encourage a significant share buyback or maybe issue a dividend to increase the return to shareholders. Do let me know if you have been following GameStop in the comments below, and hit like, hit subscribe because that helps out the channel. And as always, thank you for watching.